This is the 9th installment to the series entitled Build Your Business into an Asset of Value. What gets measured gets managed. You have a grasp of the landscape, the trade cycle mapped out, and you have a vehicle, a bespoke business model with which to embark on the journey. Now you need to plan the route ahead to arrive at specified milestones, financial goals, and you need tools, financial controls with which to measure your progress. Financial controls are the tools business owners use to measure and manage the business's progress toward achieving its goals. You don't need to reinvent the proverbial wheel. Financial controls have been created for you in the form of financial statements. You don't need to be an accountant or bookkeeper. All you need is a basic understanding of financial statements and skills with which to interpret the results reflected in the statements. As the business owner, you must set specific financial goals, and you must decide on what measures you will use to monitor the progress toward achieving those goals. Measurements in the form of financial ratios. The most effective way of keeping tabs on financial measurements is to create a dashboard of financial ratios you believe best applies to the nature of your business. In the following chapters, I introduce the format of the financial statements, including the cash flow statement, the profit and loss statement, and the statement of financial position. Thereafter, I introduce the use of a financial dashboard derived from information contained in the financial statements, and more specifically, the management accounts of the business. Cash flow to a business is like oil to a machine. With how much cash must the business start the trade cycle? And what is the appropriate minimum level of cash reserves that the business must always maintain? The cash flow statement is the most important and most neglected financial control for the business owner, and should for most businesses be updated daily. The cash flow statement consists of 5 distinct parts. Cash reserves, opening and closing balances. Maintaining appropriate levels of cash reserves is often the difference between success and failure. Nothing repels financiers and investors alike more than a business that is unable to maintain sufficient cash reserves to fund trading activities. The business owner needs to always know in real time the level of available cash reserves. Operational activities, trading. Sales revenue minus cost of sales equals gross profit. What distinguishes the cash flow statement from the profit and loss statement is that the former reflects the actual flow of cash into and out of the business in real time, whereas the latter reflects transactions completed within the accounting period. I discuss the profit and loss statement later when I address profitability. An important consideration is the duration of the trade cycle, the time that passes from the moment cash leaves the business to pay for cost of sales until cash returns to the business in the form of sales revenues. The cash flow statement enables the business owner to monitor the duration of the trade cycle in real time. Operational activities, operational expenses. The business must pay for its overheads, consisting of regular and irregular expenses. Operational expenses should be funded from the proceeds of trading activities, from gross profits. In practice, businesses provide for operational expenses on a monthly basis. Investing activities. Cash leaves when the business invests in operational or fixed assets or investments, and returns to the business when the business sells assets or realizes investments or receives investment income from investments. Financing activities. Cash or capital flows to the business when stock is issued or when the business receives debt capital from financiers. Cash or capital leaves the business when it repays debt, issues dividends to shareholders, or buy back stock from investors. Now that we understand the format of the cash flow statement, we must see what insights we can glean from the information reflected. What the business owner needs to come to terms with is the impact on cash reserves of the way sales revenues flow from customers. Here, I'm not talking about setting revenue goals. I will address revenue goals later. What is at issue here is the nature of the sales process. The business owner must consider two variables: the frequency of sales, that is the number of sales transactions per day, week, or month, and the value of sales, the monetary value of individual sales transactions. For instance, a retail business like a grocery store will typically have high frequency of sales, of individual sales of modest monetary value. Also, a grocery store typically has a short trade duration, since it sells perishable products like bread and milk. Financiers often refer to this type of business as a cash-generating business. Consequently, maintaining cash reserves equal to 1 month of operational expenses may be appropriate. In contrast, a wholesale supplier of high-value electronic equipment will typically have low frequency of sales, of individual sales of a high monetary value. Additionally, this type of business typically has a longer trade duration, often exceeding 3 months. The impact of the business losing a single sale can be substantial. Consequently, maintaining higher levels of cash reserves to fund operational expenses are appropriate. Next, we turn our attention to revenue collection. I mentioned earlier that what distinguishes the cash flow statement from the profit and loss statement is that the former reflects the actual flow of cash into and out of the business, whereas the latter reflects transactions only and within the accounting period. By updating the cash flow statement daily, the business owner can monitor the effectiveness of revenue collection, including how quickly the business collects sales revenues from customers and what proportion of money owed, sales transactions, is in fact collected as sales revenues. For instance, a retail business like a grocery store collects sales revenues from customers at the till at the time of the sales transaction, whereas a wholesale business like a supplier of fresh produce to a supermarket chain may be in a very different situation. Large corporate buyers often insist on payment terms where the supplier only receives payment, the sales revenue, 30 days after delivery. A sales transaction concluded on the 27th of February will be reflected in the profit and loss statement for the month ending February. But that does not mean that the cash flowed into the business at that time. The customer may have defaulted on the payment, or the payment may have been delayed. The cash flow statement reflects the actual flow of money, which is much more useful for the daily management of a business. Certain types of businesses collect most of its sales revenues from debtors, customers with payment terms. Effective collection of sales revenues from a debtor's book becomes an important element of managing the business's cash flow. To evaluate the impact of revenue collection on cash flow and cash reserves, the business owner must consider the following. Firstly, the proportion of sales revenues subject to payment terms. A higher risk of cash flow shortages exists where a business depends mainly on sales revenue collected from debtors, Such a business needs to consider the impact of payment defaults or delays when deciding on the minimum level of cash reserves it must maintain. Secondly, the diversity of the debtors book. External funders often request an updated debtors book age analysis reflecting the values of outstanding invoices, the value of sales revenues not yet collected. Concerns are raised when a business depends in large part on one or more debtors for most of the sales revenues. Thirdly, the payment performance of the debtors book. The quality of the debtors book is measured by the proportion of debtors that pay invoices in full and on time. Next, we consider cash flow, cost of sales. Wholesale, retail, and manufacturing businesses all procure some type of inventory, either in the form of raw materials, parts, components, or finished products, or a combination of these. But procurement costs may also include the following: transportation, logistics and delivery costs, insurance, legal costs, trade finance related costs including those associated with letters of credit, costs associated with importation or exportation of goods including forward cover, a type of insurance to protect against adverse currency movements, and sales incentives. As the trade cycle starts, money leaves the business to fund procurement costs. Cash only returns to the business as sales revenues once customers pay. Cash locked up in the trade cycle comes with a cost, including an opportunity cost. Monies invested in inventory cannot be used for any other purpose, and a finance cost. Businesses commonly fund stock purchases by way of trade finance solutions, which comes with a finance cost. Savvy business managers endeavor to shorten the trade duration of the trade cycle by negotiating payment terms with suppliers, where suppliers extend a line of credit to the business, or incentivizing buyers to pay early, where the business reward customers for paying earlier. But the cash flow requirement to fund the cost of sales can be reduced in other ways. For example, solar energy suppliers partner with a financier to offer customers a finance lease solution where the financier purchases the equipment directly from the manufacturers on behalf of the customer. The installer need not outlay any capital, that's cost of sales, for equipment, but retains the relationship with the customer by installing and maintaining the equipment. Next, we turn our attention to cash flow operational expenses. Lean and mean is where it's at for most startup businesses. Keeping and maintaining a tight grip on overheads is critical for the success of a business. Indeed, it is much easier to control costs than to generate sales revenues. It is perfectly acceptable for a business to use trade financing solutions to fund the cost of sales. However, overheads should not be funded with debt. At a minimum, a business must be able to consistently fund overheads from gross profits. A business with a trade duration of less than 1 month should generate gross profits of sufficient value to provide for its monthly overheads within the duration of a single trade cycle, whereas a business with a longer trade duration must provide for operational expenses over multiple months. For instance, a business with a trade duration of more than 2 months must generate gross profits of sufficient value to fund at least 3 months of overheads within the duration of a single trade cycle. Next, we turn our attention to cash flow investment. And first, we consider operational assets. Operational assets are used by the business to produce its product or deliver its services and may include tools and machinery, vehicles, information technology, and furniture and furnishings. Operational assets almost always depreciate in monetary value, although some operational assets may retain their usefulness for a long time. A business owner must devise a strategy, sometimes referred to as an enterprise asset management plan, to manage the acquisition, replacement and disposal of operational assets, since all this impact cash flow directly. When must operational assets be acquired in line with the business's growth plans? What are the estimated replacement costs of operational assets? And what, if any, monies may be recouped by disposing of operational assets? But a business may also decide to invest in fixed assets, such as a commercial property. I address the acquisition of commercial property later in this book. Funding for acquiring assets. A business can reduce the cash flow impact of acquiring assets by utilizing various types of financing solutions. I address these options later in the book. Discretionary investments. Small to medium-sized businesses rarely invest in medium to long-term investments, but it is certainly possible for cash to flow from the business for this purpose. Most small businesses elect to either invest surplus cash in trading activities to grow the business or opt to distribute surplus cash to shareholders in the form of dividends. Next, we turn our attention to cash flow financing. Dividends. It is the shareholders and often the founders of the business who initially invest capital in the business. Shareholders deserve to be rewarded. However, it is uncommon for small to medium-sized businesses to distribute dividends regularly to shareholders. Investors in small to medium-sized businesses are in any case likely to be more interested in seeing the value of their investment in the business grow. Investors are primarily interested in capital appreciation, not income. Debt finance. Cash flows from the business to pay off debt or to the business when it secures debt finance. Stock. Similarly, cash flows from the business when it engages in a share buyback. I will discuss this later in the book when I address mezzanine finance, and flows to the business when it issues stock, when investors buy an ownership interest in the business. Lastly, we look at cash flow cash reserves. Having reviewed the elements above, the business owner is almost ready to answer the two important questions that I mentioned at the start of this chapter, namely, how much cash must the business start the trade cycle with, and what is the appropriate minimum level of cash reserves that the business must always maintain. One last issue remains, namely a contingency fund. Good financial advisors always encourage individuals to maintain an emergency fund for unforeseen events. Likewise, a business should maintain an emergency fund. In conclusion, managing cash flow is at the heart of financial controls. This is where the action is, the daily management of the business. Thank you for watching. To access the full series, visit Constructum Online Learning on YouTube or click on the link in the post.